The secret loan documents we obtained from the Fed are a trove of surprises, but none greater than the revelation that during the height of the financial crisis, it was foreign banks that borrowed most heavily from the Fed's discount window, a facility that offered loans at below market rates. Mark Williams, an executive in residence at Boston University, is an expert in risk management of financial institutions. He was a Fed bank examiner in San Francisco and Boston and wrote a book on the rise and fall of Lehman Brothers called Uncontrollable Risk. Mark, amazing stuff in these documents. Just the mere fact that banks like Dexia and DEPFA were borrowing at some points $27 billion from the Fed has to be enough to set the alarm bells ringing for those Fed critics, wouldn't you say?
Absolutely. And we had a Middle Eastern bank as well that was partly owned by Libya that also borrowed at that discount window. So quite fascinating, almost a novel.
Okay, so what are the implications here? We've obviously heard some criticism yesterday from people like Ron Paul. You would expect, given the fact that he's written a book and the Fed, to hear from Ron Paul saying that there's a problem here. But what really is the greater impact? We know that Ben Bernanke is creating a more transparent Fed. Is this a case of you get the transparency, but be careful what you wish for?
Well, Ben Bernanke's creating a more transparent Fed, but he's doing it kicking and screaming. I mean, the market has really pushed the Fed into the 21st century. And this is just another example. I mean, the Fed's complaining and whining about providing market information, which is almost 3 years old.
I was waiting for Lizzie to jump in, but I'm going to jump in with one more question. Oh, Lizzie, go ahead. Go ahead.
Well, I want to talk about the collateral quality here as well and ask you about that, because one of the things that's also so interesting here is that we get a sense of what these banks were putting up. You've looked at Lehman Brothers. Morgan Stanley's collateral in the days after Lehman was going down was worse. So what is this telling you about the state of U.S. banks at the time and what the Fed was willing to accept, what they might be willing to accept in the future?
Well, we knew it was bad, and what we know the day that Lehman went belly up is that almost $50 billion in a discount window was lent. That's unprecedented. We also know that it wasn't just the big banks, but also medium and small banks that borrowed up to $7 billion. So it was truly a crisis. The Fed was actually lending to anyone and everyone that knocked on the door. To me, that's disturbing. The Fed actually has a role to protect the economy and to actually protect taxpayers as well. I'm not sure how Middle Eastern banks or banks from Austria or banks from Germany in particular represent the U.S. economy and the Fed's number one priority.
Mark, now that the Fed has had to open its kimono, so to speak, do you think the end result will be it changes its behavior?
Yes, and I think begrudgingly so. The Fed is moving into the 21st century, but yet this whole idea of secrecy reminds me of a scene from the old Maxwell Smart movie. You know, in essence, is the secrecy needed? The fact that they're now having to disclose information that's 2 to 3 years old, to me, that's not secret. The market has already incorporated a lot of this information. But yet, I think what we saw by the release yesterday was the detail of how bad our economy was and actually how bad the Fed allowed the economy to get at the brink before they actually helped fix the problem.
Well, Mark, we're going to have more disclosure from the Dodd-Frank law. Are we going to get that kind of detail going forward?
Right. So Dodd-Frank's required that the Fed release information, including discount window information, 2 years. Right. So in a sense, on July 22nd, 2012, we're going to get more discount information. But is that really timely? Absolutely not. I mean, the Fed's going to have to provide us with more timely information as time goes on. Look, if the Fed had done a good job leading up to the crisis, we wouldn't be asking for this information. But the fact is they did a bad job. They need to be more accountable. And this is how, in part, they can become more accountable, by providing transparency and greater reporting in the marketplace.
All right, Mark, thanks very much. Mark Williams, an executive in residence and master lecturer at Boston University. Great to have you here this morning talking about an issue that really is serious and surprising, what we learned from the Fed's documents as far as discount window lending during the financial crisis is concerned.